Good morning. Welcome to Stock Market Today. It's Wednesday, August 21st, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics, still down here in beautiful Daniel Island, South Carolina. You can find me on Twitter. I'm at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email. You can follow along with this show, get daily stock ideas for you to consider every trading day before the market opens, delivered right to your inbox. U.S. equities closed lower in Tuesday's trading after rallying on Monday, breaking a three-day streak of gains for the S&P 500. All sectors closed in the red, led by financials and materials. Treasuries were stronger across the curve. 30-year bonds still above 2%, 210 spread at 4 basis points, but still positive. The dollar was weaker versus the yen and euro. Gold finished up 30 bips. WTI crude was slightly lower. Discretionary utilities and tech outperform. Fins and materials, add staples, underperform. Investors are in a wait-and-see mode as we wait for Chairman Powell, who will speak at Jackson Hole on Friday, where he is expected to continue with a dovish tone given global growth concerns and tariff impacts. As we get to the desk this morning, futures are up 70 basis points as reports from Target and Lowe's have been well received by investors here this morning. Asian markets were mixed overnight. Japan and Australia lagged, while Hong Kong and South Korea advanced. European markets are rallying. Treasuries are weaker with the curve flattening. Dollar is stronger versus the yen and sterling. Little changed versus the euro. Gold is down 40 basis points and WTI crude is up nearly 1% to start the day. Stocks move lower after a strong two-day advance. Well-defined range at this point, I think. Support in the 2,800 to 2,850 zone, which now holds the rising 200-day moving average. Resistance is in that area between 2,900 and 2,950. RSI still can't get back above 50, so momentum still in bearish ranges. Rallies have not been able to produce an RSI reading that takes it back into bullish ranges, and that is troublesome to me. Chaikin money flow is bullish here in the near term, but an interesting dynamic at play. Series of lower highs with every market top, so just something to keep in mind. The indicators are mixed at this point. The RSI is what bothers me the most. I think what we're seeing here points to a wide trading range that we have now been talking about for over a week. We've been saying we are open to the idea of a wide range for the S&P 500, and within that environment, we want to focus on what's leading. We want to avoid what's lagging, and we want to look for opportunities on both sides of the book. Your market in a minute now. What am I talking about in my note today to Chaikin Analytics clients? S&P 500 snaps a 3-day winning streak. Sentiment remains fearful, and we're going to actually show you why that could lead to opportunities for contrarian bulls. Qs continue to lead the major markets in the U.S. If you look at SPY, Qs, IWM, kind of these groups that we look at, the Qs are the place to be from a relative strength standpoint. Futures do point to a higher open here today, as we said. Now let's take a look at the power bars. Some deterioration with the decline in markets yesterday. Dow loses 66 basis points. 3-1 bears to bulls. 9 bearish or very bearish stocks. Only 3 bullish or very bullish stocks. S&P 500 remains skewed in favor of the bears. 103 bears to 77 bulls. Down 80 bips yesterday. NASDAQ inline performer to the downside. 24 bears, 20 bulls. Small caps still skewed bullishly. 392 bullish or very bullish stocks for 363 bearish or very bearish stocks, but just continues to be the major market that we want to avoid. Massive underperformer, no real signs of a change from a relative strength standpoint just yet. So until that happens, we want to continue to avoid that area of the market. According to the Chaikin Power Bar, small cap stocks remain somewhat more bullish than large stocks. Major markets are mixed. Let's take a look at our stock of the day, Synovus. SNV closed at 35.19, down 2% yesterday. Power gauge rating very bullish due to very strong earnings performance, attractive financial metrics, strong price volume activity, as well as positive expert activity. But despite being a very bullish stock with a strong trend and a strong industry, we're gonna leave it alone, right? And you should immediately be able to see why. Relative strength not there, hasn't been there in a year. There's been no reason to own this stock for the past 12 months. We want the market and model to be in agreement. Now, we can say that the relative performance has been improving of late, but you could have made that same argument back in the February-March timeframe and front run and bought this breakout, breaking with the process, and you'd have been long the stock at 40, and now it's at 35. Horrible trade if you broke the process and tried to front run owning bullish stocks that are outperforming, right? Don't be tempted to make that same mistake here. Keep Synovus on a bullish watch list. Look for opportunities when the stock is outperforming, right? If it's outperforming and it's still very bullish and it becomes oversold like it is now with bullish money flow like it has now, then that's a premium setup and that's an opportunity. But remember, the most important factor is the power gauge, and then right after that is relative strength against the market. And if the two are not together, it doesn't make sense to take a position. Let's look at our sector tracker now and our industry focus. Now, the sectors, taking a look at what's moving over the last 5 days, still a very defensive feel at the top of the list. Utilities, staples, and REITs, the only three sectors higher over the past 5 days as rates turn lower and as investors rotate into defensive areas of the market. Tech, industrials, discretionary, and healthcare are middle of the road. Comms really just done a whole lot of nothing for a while. For those of you who read my Tuesday note, you all know that. Materials is a group that we've been warming to, although it's been giving some back as there's been a little bit of profit taking in the precious metals over the past couple of days, especially Friday and Monday as the market was rallying. Fins continue to be a group to avoid with rates heading lower. We've been all over the rate trade, folks. We've been talking about 10-year yield and the path of least resistance lower and kind of skewing more towards the bond proxy, skewing away from the rate sensitive names. Listen, I mean, it's been unheard of for a long time, but there's scope for rates to even move lower from here. The rest of the world or major parts of the world have debt yielding less than zero. There's no reason to believe that the U.S. 10-year can't keep going lower. Energy remains a group that we just want to avoid at all costs for right now. Just bearish fundamentals, bearish market trend. Industry in focus today, transport services over the past 6 months has underperformed the S&P 500 by 9.5%. Its power bar ratio, which measures future potential, is weak. We have 11 bearish stocks, 5 bullish stocks, so a group that we continue to want to avoid because we think this underperformance is likely to continue. It's currently ranked number 16 of 21 subsectors, and the names there that we want to avoid or look for bearish opportunities when they set up, which they don't now. They're all oversold. Union Pacific, UNP, very bearish rating. Avis Budget, CAR, very bearish rating. And Kirby Corp, KEX, also with a very bearish Chaikin power gauge rating. And let's look at the fund here. Bearish ETF rating for XTN, the transport ETF. You can see that power bar ratio 11-5. Weak trend. Underperforming. So the funds work the same way, right? Bearish rating, underperforming the market. This is where we want to go looking for bearish ideas. Or if you trade ETFs, look for an opportunity to open bearish. I would say we're not there yet because we are closer to oversold with bullish money flow, but a steady downtrend below a declining long-term trend line. For those of you who trade individual names, I think you want to use XTN to find bearish setups when bearish and very bearish stocks become overbought with bearish money flow. For those of you who trade the ETF, continue to watch it here. If the overbought oversold indicator makes its way back towards 70, all else being equal, could be a good opportunity to take a trade to the bearish side in the ETF. Let's look at what's trending now. Yesterday's S&P 500 movers and shakers, our gainers and losers. Home Depot up 4.4% following their earnings report. Raytheon up 3.5% as it was added to the U.S. 1 list at Bank of America Merrill Lynch yesterday. Lowe's was up with Home Depot 3%, and I'll note that they are trading higher by about 13% this morning following their earnings announcement. Medtronic beat and raised, and MAS up 2% as there seems to be some interest for part of their business from private equity. On the loser side of the board, earnings sent Kohl's down nearly 7%. Dow down 5.5%. Didn't see any real news there. Macy's follows through to the downside after their dismal print and gets no help from Kohl's. Macy's down 4.75%. CAG down 4.5% as JP Morgan cut estimates. And it looks like JP Morgan was making some moves in the food space because they took McCormick, they took the rating down. Stock caught a downgrade, down 4.35%. on the day. So it's interesting dynamic at play here. In our note today, we're actually highlighting XHB, the home builder ETF, right? Depot does well, Lowe's does well, right? That part of retailing is doing well, and that's where you want to focus. But if you're looking at names like Macy's and Kohl's and some of these department stores, Nordstrom, been an absolute disaster. Know where you're focused, know where the leadership is in the marketplace. Speaking of leadership, QQQ is leadership for the majors. Here's the Invesco QQQ Trust, the NASDAQ 100 essentially, above the rising 200-day moving average. Now consolidating similar to the S&P 500, having trouble breaking back above. I'm not going to argue there, but if we're looking for relative strength, you can see a nice steady uptrend relative to the SPY and a little bit of an acceleration off of that uptrend as well. So as I'm looking for ideas in the marketplace, as I'm looking for premium setups, one of the areas that I'm looking is within the holdings of the Qs, because I think that their outperformance is likely to continue in the near term. But again, very much a two-way market right now. We've been talking about the trading range. We continue to think that that's the case. Same dynamic at play for the Qs, but I think that over time, Qs are going to continue to outperform. So as we're skirting towards the outperformance, part of the market we want to look at is QQQ. Small caps remain a group to avoid on a relative basis. I want to say on an absolute basis now too. If you notice, S&P 500 is above its 200-day moving average. Qs are above a 200-day moving average. Both those moving averages are rising. Look at the IWM. Below its 200-day moving average, which is flat at best, right? Nice rounding top here. Momentum in bearish ranges. Notice how momentum has not been able to become overbought since February and continues to just drift lower. That's a confirmation from momentum to a bearish, or at the very least a neutral trend for the IWM. So again, when we're thinking about ideas and we're looking for opportunities in the marketplace, if we have a choice between a large cap stock and a small cap stock that both have similar attributes, we want to skew towards the large cap stock. And you can see at the bottom of the chart, IWM relative to the SPY. I mean, folks, that is what we would call a textbook downtrend, right? We've been talking about it for a while. This is another theme that we've kind of been pounding the table on for a long time. And you can see how these trends, once they get going, tend to persist. It's why I like to follow trends in the marketplace. And it's why we like to skirt to the relative strength, because when these trends get going, they tend to last. This group has been underperforming the market for more than a year. Continue to avoid the small caps. Builders get a boost. Now, I said we're going to highlight XHB in our note. We're going to take a look at this chart here. XHB, the SPDR S&P Home Builder ETF, quickly regains support, or broken support, turned resistance back above the line. Notice that during this consolidation here, RSI did not become oversold, right? So momentum was remaining with this trend. Fund is above a rising 200-day moving average. So all of that is encouraging. On a relative basis, we can see that XHB is in a nice steady uptrend against the SPY, and there's reason to believe that that trend will continue based on the dynamics at play. So we're highlighting XHB in our note today, and we continue to see opportunities there. Drill down on the holdings in XHB and look for the bullish and very bullish stocks that are outperforming, and look for the opportunities in those stocks, especially when they're oversold, with bullish money flow. And we said we talk about sentiment. Here it is. Sentiment is at contrarian levels. This is the 13-period moving average of the CBOE put-call ratio. And it has crossed above 1.1, and that tends to coincide with near-term lows for the S&P 500. As a matter of fact, we looked at data going back to 2006, and when this metric, the 13-period moving average, crosses above 1.1, S&P 500 is higher over the next 3 months, 68% of the time, for about 6.08%. So some solid positive activity on average for the market during this crossover. So when we say this is at contrarian levels, this is what we're talking about, especially as the fund holds above the 200-day moving average. So that is going to wrap it up for today, folks. Head over to chaikinanalytics.com/survival-guide. Sign up for your weekly action plan for surviving and thriving in any market environment. This is an in-depth, broad note that I publish once a week where I look at themes across markets and across assets classes, gold, treasuries. We've seen them all. I'll see you tomorrow, folks.